Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Monday edition of 7 Investing Now. My name is Daniel Brooks Kline. My friends call me Dan. You can call me Dan. I'm being joined today by Steve Symington and a last-minute addition, Max Chatsko. Steve, it's 28 degrees in Montana, and you seem delighted by that.
Oh, that's fantastic. That's t-shirt shorts weather for us up here. I love it.
It is 78 degrees here in West Palm Beach, and people didn't go to the pool. Max, what's it like in Pittsburgh, other than virus infected?
Yeah, it's always cloudy and dreary here, so it's par for the course.
So as you know, 7 Investing Now covers the news of the day, but from a long-term investing perspective. We're going to start with our top story. We're going to talk about the upcoming Doordash Ipo. Then we're going to go to what we're watching, where we're going to hit a little bit of what might happen with stimulus, and Max is going to tell us about the ASH conference. That is something many of us don't know about, where a lot of big news is coming. We're actually going to do a whole show on that on Wednesday with Max and Manisha Samy. But let's get right to it. Our top story for today. The Doordash IPO is this week. And of course, they've raised the price. They're going to sell 33 million shares at $90 to $95. That's up from $75 to $85. They're going to it's going to give them a market valuation of about $30 billion. Steve, this is an unprofitable company with ridiculous numbers. What am I missing here?
Yeah, I don't know. You recapped it fairly well right there.
Okay, we're done. We will see.
Yeah, I've never been particularly fond of the economics of food delivery, and I mean, what an opportunity for them to raise a lot of cash and to bolster their business that way. But I do question their ability to drive to sustain profitability, given the unfavorable economics of food delivery. So, yeah, we'll see. And I'm a skeptic, but we'll see.
So they're the biggest food delivery service, but I'm not sure that's a good thing. So you pointed out a number to me earlier. They claim 18 million customers. That sounds like a good number, but they have 1 million delivery workers. 1 worker per 18 customers. I understand these aren't full-time workers. We're also not full-time customers. You only order once, twice, maybe 3 times a week. How does this work, Steve? Like this seems to me like you're working harder and harder, and the eventual payoff is maybe you figure out how to make like a tiny bit of money by delivering, like, I don't know, dry cleaning and groceries along with food.
Right. And I think the challenge here is that, you're sharing that revenue, and as they scale, it's difficult for them to scale without expenses also scaling higher. There is the Dash Pass service. What is it? $10 a month, $9.99 per month. That they have that could kind of help them scale, assuming people don't leverage it as much as potentially, they'll get people to subscribe. And I guess the idea with some of these subscription services in particular are that some people won't leverage it as much as others will, and they might be more profitable customers. But again, kind of a tricky business. And
Steve, that feels like MoviePass to me. Like, we're going to charge you this amount, and you can use unlimited, but we hope you use nothing. Mm-hmm. If I paid $10 a month for Dash Pass, I would absolutely use DoorDash more often. But there are some good things here. So in their most recent quarter, they reported $1.9 billion in revenue. That's for 9 months ending September 30th, and a net loss of $149 million. That does clean up their loss, which was $533 million over the same period. But Steve, I just don't see this as being like traditional technology where you invest, and losing is okay. Right. It seems like the core business here is kind of a money loser.
Yeah, and I hope they prove me wrong. But that's kind of again, tough economics, and it's tough for me to justify. We're talking about the biggest business, as you said, in a money losing space. And it's the valuation, by comparison, Grubhub, I think last I checked, its market cap was like $6 billion. And this will make it larger by a factor of 5, and it should be something to watch. But
I'm going to ask you one more question. I'll answer it myself. My biggest problem with this business is I don't have any loyalty. So I will open up Grubhub first, because that's just the one I used first. Sure. And I'll look and see if there's a restaurant that appeals to me. And if there is, Grubhub. then I might go to DoorDash, or I might go to Uber Eats, or I might go to Postmates, or I might go to, there's a local one here called Delivery Dudes. There's another one called Cravey. Some of them have differing restaurants. So I might go, oh, geez, where's the one that has, Outback Steakhouse? And it just seems to me like there's absolutely no differentiating in the service. So why would I care about whether I'm a DoorDash customer or not?
I think the question comes down to which restaurants care, not so much consumers, because I'm the same way. I'm not necessarily someone who checks to see if a restaurant appeals to me that a particular service offers. I'm someone who wants to eat, at Buffalo Wild Wings or something, and I see who's delivering. I don't care who brings it to my door, but companies might. And that's the key, I think, in this case, is watching which companies, and the network effects should be helpful there for continuing to expand their scale. And this might be a case of a company that is growing its enterprise value, sacrificing bottom line profits in favor of driving top line growth and taking extra market share from competitors, because DoorDash has almost half the meal delivery sales in the country last month, right?
They have about half of it. The problem is success is dependent on not having much competition, because it's kind of a race to the bottom in terms of fees. So DoorDash, goes to the Italian place near me that's really popular, that isn't on any delivery service, and they say, geez, we would love to have you, and this is the deal we'll give you. And they'll say, well, Uber Eats offered us this deal, and it just seems to me a very, very difficult game to play. We're going to keep watching this space. We would love your questions. No matter where you're watching, you can ask us questions. So feel free. We will share them as best we can. Steve, final word on DoorDash. This is just one. I wouldn't touch this one. I have no interest in it. Any thoughts for you?
Same. I'm stepping back and I'm watching it play out. Good on them for being able to raise money, but I won't be participating in this one.
This feels to me like a business, not an investment. I hope they can get to profitability. I don't think there's going to be a ton of money for investors. We're going to move on to what we're watching. We're going to stick with Steve. We'll get Max involved, I promise. Steve, you wanted to talk about COVID stimulus part 2. Congress is negotiating, which is a little tricky. It's a lame duck Congress. It's a lame duck president. But where do we stand right now on COVID stimulus? I know everyone feels like we need something.
COVID stimulus part 2, many eyes right now on this second stimulus package from Congress. And there's lots of speculation on Wall Street right now that this could serve as one of two things: either a spark for markets to continue climbing higher because they're concerned about the economic fallout of not passing such a package, or two, it could be a flipping point for a potential correction if we don't get it, because they'll be concerned that the economy will be hurt without further stimulus. Nothing is for certain right now. We have Senate Majority Leader Mitch McConnell on one hand. He wants a targeted $500 billion stimulus package. House Speaker Nancy Pelosi, on the other hand, wants something that's over $2 trillion. She wants a more sweeping aid effort. And a bipartisan group of lawmakers has tried to find something kind of in between. I believe there was a $908 billion stimulus package up for negotiation right now that Democratic leaders incidentally have backed already. That includes reinstating $300 a week unemployment supplement, state and local government aid, and $300 billion in new PPP loans. Might not be a fix-all, but it's a start and could help stave off deeper economic woes until the pandemic has begun to wane. So something to watch again. But I think the near-term market direction will depend on what happens there with the stimulus. Shouldn't be of tremendous consequence for long-term patient investors who are trying to find businesses that survive and thrive no matter what. But the broader market will almost certainly, in my view, the direction will depend on what happens with the stimulus this week.
Yeah, I don't think it's going to matter one way or the other. Let's take a question. We were talking IPOs before, and we're going to get a question from JE here on Airbnb, which is Airbnb. This is another upcoming IPO that could happen as quickly. And it's also another one that I'm wary of. They shouldn't have a lot of cost. All the inventory isn't theirs. A lot of the marketing isn't theirs. Yet they're still they're not making money like you'd hoped they would. It's one I haven't looked at that many times, but I like the business. I've stayed at Airbnbs. I also think they have a product that they don't control. So a couple of times I've stayed at Airbnbs and they weren't everything the pictures looked like. Sometimes it was willful. Sometimes it was just like, well, that is a nice looking piece of furniture, but it's not comfortable, or the bed's lumpy, or whatever it is. I don't really love when a business doesn't control its end product. I'll probably read a couple of quarters earnings calls, but I don't think it's one I'd really want to get into. Steve, Max, any thoughts here?
You know what? I've done very little research on Airbnb. I'm not particularly interested in the business as it stands, but it's something that I'll be watching. I think I'll give it a quarter or two to better understand its economics. I think so. I don't mind putting a little distance between its IPO. There are some cases, and 7 Investing subscribers will know that, where I'll dive right in shortly after the IPO. But most of the time, I like giving it a couple of quarters before. Just to kind of give them some legs as a publicly traded company and let some of that volatility pass.
Yeah, I almost never believe in buying an IPO right away. I think it's a really risky strategy. Max, I know we've had you in the background. You've been sitting there. But before we get to you, let's remind everybody, this show is brought to you by 7 Investing. What's 7 Investing? You subscribe, you give us $17 a month or $170 a year, and you get our 7 best stock picks each month. Each one of us makes one pick, and then you get access to not only our write-up, but we do a massive call. It takes like 3 hours where we each pitch our stock, and everybody gets to ask questions. So not only do you get the bull case, you also get the bear case. You get all sorts of access. We do a new members call. We do a members-only call. Like this show, but imagine there's only a handful of you watching, and you can be really interactive. With that, Max, you wanted to talk about the Ash conference, which I just assumed was something related to Pokemon, where we all dress up as Ash Ketchum. You told me that is not the case. Explain what the Ash conference is and why we should be interested in it.
Yeah, no, Dan, that's a different Ash conference. That's in the summer. But the Ash conference every December is the American Society of Hematology, ASH. So it's one of the biggest events in the healthcare sector every year. And like I said, it's every December. It's going on right now. It's from December 5th through the 8th. So it'll be to the end of tomorrow. So hematology is the study of blood. Blood's pretty important. I think you've heard, right? So we know of blood as in like the red blood cells, but your red blood cells actually are one of the few cells that don't have any of your DNA in them. So we can't edit the DNA because it doesn't have it. If you want to fix some disease you have, whether it's a genetic condition, but blood, when we talk about it in terms of hematology, it's all the things that are coursing through your veins, quite literally. Red blood cells, there's different immune cells that are patrolling to protect you from infection, and different signals we can pick up. There's circulating tumor DNA. So liquid biopsies have been very big in the last couple of years. So blood has really taken on this huge importance in terms of healthcare because it can signal a lot of different things for disease, for cancers, and specifically even blood cancers, right?
So Max, as an investor, and we're going to do a whole show about this conference with Manisha Samy and you on Wednesday, so you don't have to get into any of the specific companies, but what were you watching for? Are you watching for new announcements? Are you watching for breakthroughs, for approvals? Kind of what type of stuff gets announced at the ASH conference?
Yeah, exactly. So Wednesday, we're going to dive into maybe some more specifics of like what companies have presented or something we're watching specifically. But yeah, just as like the 10,000 foot view, this is a place where academic groups, companies, they release study results, clinical trial results. These are huge movers for these companies. Like today, we've seen, because there's presentations over the weekend, press releases over the weekend. So today is the first day you can actually trade the news, so to speak. We're seeing a lot of big movements. As long-term investors, it's important to, keep an eye on these things. But someone asked on Twitter, because I mentioned that we did a podcast, me, Manisha, and Simon last week. We spoke about 4 different companies that we were watching, and they're all having pretty good days today because they had some really interesting results over the weekend. And someone on Twitter said, well, the fundamentals of these companies didn't change in 3 days. So what do you mean, like research? Why does that even matter? Well, here it's, research into the science and the technical technology platforms rather that they have. And that's a little bit more difficult to understand sometimes, so that's what Manish and I really dig into. But it's, so there's Lost my train of thought there.
I will save you from yourself there. So it's one of those things where when companies are in sort of the early stage, the speculative stage, now the whole company might not be speculative, but some of their products are. It's you want to see where they are, what new things they've done, what they're telling you. It's kind of like this is like the one time of year where, aside from earnings, where they're really doling out information, and they're doling it out in, is it fair to say, Max, like a kind of critical environment? Like there's people there that are going to ask questions.
Yeah, exactly. So, you're presenting to your fellow, science community, right? So back to what I was saying with fundamentals. Yeah. So, when we're looking at these companies, drug developers, Manish and I are saying like, oh, well, look, revenue's up 15% from the last quarter. A lot of these companies don't even have revenue. So valuing drug developers, and, it does seem it's inefficient for one, which is why we see, some news gets released. I mean, there's a couple companies releasing data from mice that are up like 10% today, right?
So data from research on mice, not from mice researchers. I think that's important to state.
Right. Hey, you never know, man. Some innovation there. Some mouse researchers, they're cheaper. Yeah. So evaluating these companies is inefficient. The market's often wrong. So that's why you see some of these big pops. It's not necessarily the fundamentals have changed, but people are starting to price in like, oh wow, this might be the winner in this specific disease or indication. So just one closing thought I have, though, is this year, I think everyone looks good. Everyone looks like a genius in investing, right? Biotech's been very good. A lot of stocks are up. But there are dozens of companies taking advantage of some of the recent tools that have come out in biotech. And, there's dozens of companies that are chasing the same disease or targeting the same disease. A lot of those stocks are up based on, well, what if? But I think in the next year or two, and maybe even we've seen some movements today where one company came out, had really, really good results, had no side effects that we've seen in other companies that are doing the same thing. And it took a 45% gain today. And some of the companies doing the same thing are not moving at all. And even if they had good results over the weekend. So I think we're going to see many losers over the next few years and some very, very big winners, but only a handful of those.
When you're investing in this space where there's no revenue, where the products are speculative, you got to remember that's what you're doing. And that goes to a question we have from Kadush Dedhar. I apologize, I'm not saying your name right. It's kind of far away. I can't see it. And he asked, any thoughts on NanoX? And yeah, my thought is we've talked about this one a lot. It's very speculative. It is a risk. I'll throw out one more question, and it's not fair. So I'll try to give you guys a little time to think about it. Are there any IPOs you're really looking forward to? I'm really curious about the Roblox IPO. It's not a company that was really on my radar. My son's a little older than that game is. But I am kind of curious to see how it goes. I don't generally invest in that type of gaming company, by which I mean, games for consumers, for kids, as opposed to like casino gaming. I don't really invest there either. Steve, I'll go to you first. Is there anything, maybe one of the SPACs coming up, one of the IPOs coming up that you're really excited about?
Man, Roblox is going to be one of those that should be really interesting, if only because my kids are interested in it and constantly. But I'll be curious to see what kind of optionality they have. That should be pretty interesting for me. Otherwise, I mean, nothing super big on my radar that I'm watching that's more compelling than the stocks that I've already found. But
I take the general take that there's no reason to watch IPOs, and I get it. Some of them have had like crazy bumps, but unless I could get shares at the offering price, there's no reason not to step back a couple of months. Max, you don't have to have an answer, but if you do, feel free. Is there anything you're watching?
Not necessarily, but I was very, very much looking forward to a SPAC recently of QuantumScape. So that is a developer of something called solid state batteries. So solid state batteries on paper, I think, are the obvious future of electrification, whether it's for our phones or our cars or even heavy duty trucking. But then if you look at the actual company's timeline, they're not going to have any like manufacturing facilities up until like 2026 or 27. So going on the public markets now in the year 2020, I mean, investors are just going to be sitting there for like 6 or 7 years. So I did not participate in that, but I'll be watching it. But you have a ton of time, obviously, right? 7 years, geez.
Yeah, one more IPO.
Yeah, absolutely, Steve. Jump in.
Potential is the Robinhood IPO. There's nothing formal as far as last I checked. That popped into my head just now. I recall last month there was a report that Robinhood was soliciting pitches for a potential IPO in 2021. And you could pretty well guarantee that if that gains any traction, it's going to dominate headlines for a while. So if only for the economics of their underlying business, and it's going to draw some attention to how they make money and the kinds of clients that they cater to. So Robinhood IPO should be potentially really interesting next year. Not saying it would be fully investable, but interesting.
I'm curious to follow it, but I would rather buy a Yugo that's already on fire. Their business model is not one I'd want to be a part of. It's, we teach people how to invest for the long term. They don't. I think it's fair to say. Do you
guys think that business model is sustainable? Like, do you think all the investors that have come into the market this year are going to stick around when the market's only getting maybe 3% a year instead of, whatever it's doing this year?
So it's going to go two ways. There's going to be the people that get burnt because they're buying stocks they know nothing about, that some jerk is picking out of a Scrabble bag or who knows what, And there's going to be some people that get burned and decide, I want to learn how to be an investor, and hopefully they're going to come to us. That's kind of why we're doing this show on a public-facing platform, is we do want to show people that there is a better way. And look, are there people with a ton of money that make money trading? Sure. But the average person putting in a few $100, few $1,000, whatever it is, long-term investing is the way to go. That's what we teach you. And Robinhood, you can be a long-term investor on Robinhood. People generally aren't. We're entering the home stretch here. We're going to play a game. Called it 4 questions. And originally, I was going to ask Steve 4 questions. Steve was going to ask me 4 questions. Because Max joined us, I'm going to ask each of you. We're going to start with Max, and then we're going to go to Steve. Question 1. Are there any types of investments you simply won't make? Max.
Yeah, I tend to stay away from stocks that have become like the momentum stocks, right? Like everyone knows about them and they're buying them just for the heck of it. I did that before when I was starting investing, and it doesn't work out so well. At least that's what I found. So, again, the market's doing very well this year, but how much is being priced in? What does that mean for future returns? And I think a lot of people are getting into things they don't necessarily understand. So even if there's a good business, but I think it's overvalued, I'm probably going to stay away.
It's really important to know who you're taking advice from. If it's a Facebook group, that is probably not the way to go. And the stocks we get asked about the most often, I would say 8 out of 10 of them are probably bad investments if you don't really understand the company. Right. Steve, your thoughts here. Are there any types of investments you won't make?
Stocks, I don't even need to hesitate. I will not buy. And it's more specifically, we're talking about like super micro cap penny stocks, those that are trading for like a 100th of a penny or something ridiculous. A lot of times these are just super high risk companies. 99% of the time they'll go to zero, and or they'll be subject to pump and dump schemes where you have companies literally hiring copywriters to write and then they get arrested by the SEC, which has happened a couple of years ago, a big group of them. But micro cap penny stocks I don't even touch. They're super risky, and seldom do they actually translate to a viable large publicly traded business. But generally, if you're going to find me starting, I'll look in the $100 to $200 million range is the smaller end of what I'm trying to find, and those are still really small companies. And but you won't find me buying penny stocks despite the urgings of so many people to do so.
But Steve, you can get like 1,000 shares for like, come on, man, great deal.
Yeah, that leads to maybe another question, but
and that's what tricks people. They get the idea of, oh my God, I can buy 100,000 shares, and if it only goes to a quarter, which is pretty much every business pitch saying like, well, what if I could become the Chipotle of Chinese food? Like maybe, but almost certainly not. So you need to be careful. We welcome your comments. We got a little bit of time left. We've got 3 more questions, then we've got our finisher. But feel free to get your questions in comments in the queue. Max, question 2. What company that you once owned were you most wrong about? Max.
Yeah, so this company actually has had a huge impact on my style as an investor. So 5 years ago now. I used to own a company called Amyris. It's an industrial biotech company. They had it looked like they were turning a corner. Maybe they were becoming profitable, and then it just didn't work out. I don't know. And so their management team, even today, I don't really believe in. I don't trust in. I think they need a huge change in CEO. I think they have the wrong business model. They've been investigated by the SEC in recent years, even after I owned them. So that's a huge red flag, obviously, right? And then if you look at some of their SEC filings, even right now, their most recent quarterly filing, their 10Q, they're doing something funny with deferred cost of product revenue. So even now, I mean, this company just keeps, I don't know, I just don't trust them. And so I would stay away from them.
Steve, your thoughts here?
I've had my fair share. I used to own shares of GE. I think back in 2005 or 2006.
They bring good things to life.
Oh, goodness sakes. There were so many moving parts to that business, and so much anchoring them down, holding them back. And I think it was one of those, how could you go wrong with GE back then? And I sold it for a modest profit just in time, it turns out. But I realized that I didn't understand the business well enough, and I cut bait with that one a long time ago. But I look back and what would have happened? And you're like, ooh, ouch! You look at GE's chart, but that's right up there with the companies that I was wrong about a long time ago.
My worst bet. It was also my worst performer on the tracking system at the place we used to work. Was JCPenney. And I don't mean recent JCPenney. I mean when they fired Ron Johnson, they brought back their previous CEO. They looked like they were back on the right course. I was fully wrong. Now, I got out of it well before the dreadful bottom, but it still shows you that even a company with a plan, a lot of things have to go right. And I actually think JCPenney over the years, not so much recently, made a lot of the right moves, but the market had moved on. And it wasn't a lot of money, but still never fun. Question 3, how much risk tolerance do you have? Not a ton of risk tolerance in my portfolio. I tend to be pretty conservative. Max, you go first.
Well, obviously, I think I have more risk tolerance, right? I'm in drug developers that don't have revenue and things like that. But I would also counter that, from the outside, it looks like I choose a lot of risky companies. But I think, my investing approach is bottom up, right? So I try to really understand the technical developments, the technology platform. I try to look at the broader market, where it fits in competitively, what's going on in terms of, competition behind it, ahead of it. Is it leading a field forward? So, I pick my spots. I'm not just shotgunning, approaching, this sounds cool. CRISPR. Yeah, I don't know. It's going to change the world, right? Those slogans. I know I do. So the bottom up approach, I feel like it's not as risky. Maybe that's just what I tell myself, but I've avoided a lot of big losers, or again, some of those momentum stocks that do well in the short term, and then eventually it kind of all falls down because there's something fundamentally wrong with the technology. So, but yeah, I guess obviously I have a higher risk tolerance than you, Dan.
Well, it's also very important to know that some of it is invest in what you know. So, I've been buying either your recommendation or Manisha's recommendation every month, just a small amount, because I want exposure to some companies I don't really understand. And I feel comfortable doing that because I know the level of research you guys are putting in. Look, you sat through the ASH conference. That is not something you could pay me to do. I'm going to guess you're not going to want to go sit through a retail conference or a grocery store conference. So that's part of why you join 7 Investing, is you get access to people who spend all their time studying this stuff. I spend from 7 in the morning to who knows when at night reading about half the time and just doing research. I know Steve, Max, Manisha, everybody does the same. And when we're not in a pandemic, we go to trade shows, we speak to industry experts. That is why you want to be a member. And of course, you can join at 7investing.com/subscribe. Steve Symington, your answer on how much risk tolerance do you have?
A lot. And I think there's an important caveat to that, though, too. Similar to what Max said, high risk doesn't equal not doing your homework and buying companies you don't understand. The companies that I recommend will often be considered very high risk, but these are companies that, in some cases, I've done over 100 hours of research into a company like this. And sometimes it's a company that I've owned shares of for a decade. And people are like, really, hundreds of hours of research. And yes, these are companies that we have studied for years. And sometimes they're companies that are only recently public, and I'll read their entire S1 filing, and these are companies that we need to understand deeply their opportunities. And just because they're high risk, often that just means they can be really volatile. They might be unprofitable, but with a road to profitability, or perhaps they'll forsake it for years before they even consider letting profits fall to their bottom line. But I don't mind volatility. I don't mind taking risk as long as it is educated, calculated risk. So that's where I fall.
A lot of the companies we pick, it's not so much about knowing the company, it's about understanding the operating environment, sort of who they're competing with, what they're fighting against. In Max's case, there's a ton of regulation. It's really about building a knowledge base, not just knowing the numbers for any given company. But let's get to the fourth question. What investing advice do you hear that makes you most angry? There's a lot of bad investing advice out there. Max, you get to go first.
Yeah, so kind of following up to what Steve just said, actually, and this might sound odd at first, but the investing advice that I kind of can't stand when people say is off the cuff. They'll say, well, do your due diligence. It's almost like a throwaway line, right? I mean, how many times have you seen that? And I don't think it provides enough of like the context and nuance of, well, what does that mean? Like you actually have to, read a lot of different sources, spend a lot of time, read SEC filings. I think, I don't know the exact quote, but Warren Buffett has a good quote about reading through SEC filings, right? And if you've ever done it, there's a lot of information there that isn't published on articles or in the company presentations, right? They might slide some stuff in there that's not so flattering. So definitely, like people say, do your due diligence. You have to understand what that means, and develop a framework for how you evaluate companies that you're going to own.
Yeah, and you have to understand context. I don't know if you guys remember, a few years ago, there were all these newspaper articles. Chipotle might run out of avocados, which will mean no guacamole. Well, that was in the section of their annual report where you basically have to list all the terrible things that might go wrong. People might all become allergic to tacos. Our CEO might be abducted by aliens. I'm being a little silly, but you basically have to say okay, what if there's a famine and it wipes out all the pork? And that's not so preposterous given what happened with pigs in China. So that got reported. And if you were someone who was looking at investing in Chipotle, you might go, oh my God, well, if they don't have, guacamole, they're not going to do as well. And the reality was they might have short-term supply issues in some parts of the country. It wasn't a major story. Steve, the worst investing advice you regularly hear given.
Putting aside recommendations for micro cap penny stocks, that's right up there. But if in the interest of hedging our bets a little bit, don't buy that stock. It's too expensive. By what metric? That's really difficult. And not buying a stock simply because it looks expensive on paper is a huge mistake. And we've mentioned that already in this live stream already. All too often, some of the stocks that people avoid buying have been called expensive for years, and they've continued to deliver market-beating gains. So I never dismiss a stock, and often that's a contrary signal to maybe take a closer look at the stock, see if it's expensive for a reason or if it can grow into whatever valuation people are balking at.
People were calling.
I would like to jump in. Actually, this is so when I was one of those people. I'm guilty as charged. I think Steve's talking about me.
No, I wasn't thinking about you.
But when I joined Seven Investing, I mean, that was one of the things I was excited about. I felt a little stagnant at the old place. I wasn't really learning as much. So here, we get to mix everything together and we learn from each other. And I've learned a lot about that just on valuing companies. The companies that look expensive tend to be the winners, and the winners just keep getting better and bigger over time. So, and also, Simon brought this up on a recent podcast that we did. A lot of times these companies that are expensive, it's because they're, in institutional investors' portfolios. They have to be, right? There's certain requirements. So there's almost like a floor to some of these companies that look expensive where, they're going to be at a premium market cap maybe for forever, for a very long time. So definitely what Steve just said, don't hesitate to buy a company just because it looks expensive. And there's different definitions of expensive, of course.
A lot of people called Amazon or Microsoft expensive a decade ago and left a lot of money on the table. And I'm going to take one question from Max Lucas here. He says, the worst advice is play with the house's money. And what this means is, and this is terrible advice, it's often something said by, our nemesis, Jim Cramer, and teasing a little bit, but we'd like people to, to understand where we're different. What he says is, well, once you've made back your initial amount of money, sell some shares, and then you're playing with the house's money. Take back your investment. Here's the problem. That generally means you're selling shares of your best investments. So it's your money. They're your shares. If your thesis holds and you still believe the company is going to go up, then stay invested. And now that being said, if it's become 50% of your portfolio and you're nervous, well, go ahead, sell some of it. My biggest position is Microsoft. And it's not because I set out for it to be my biggest position. It's because it's done well. I haven't sold any because I think it's going to continue to do well. I'm not worried about the house's money or protecting my initial investment. I'm worried about investing for the long term. Guys, that was a home stretch. Now it is time to hit our finisher. Sam Bailey, our director of marketing. Which stock has your strongest conviction? C Limited won this overwhelmingly, almost 60%. Mercado Libre came in at 20.5%, Alibaba at 11.2%, Snowflake at 8.8%. I actually think Mercado Libre, if I had to pick one that I'm pretty convinced it's doing well, they own payment in their part of the world, and they don't face significant competition, which C Limited does. Steve Symington, your thoughts here?
I voted for C Limited in that survey. That's okay. There's nothing wrong with Mercado Libre or Alibaba. They're fantastic businesses, large cap companies. Snowflake, I think, has some questions that need to be answered, and I'm actually diving further into that as we speak. But there's some uncertainty there. But C Limited is one of those really fast growing kind of digital commerce and gaming. Man, they've got some wide reach, and it's an exciting business. And it is one of those stocks that has roared higher. And I think if I was going to pick out of those four companies, which one is going to continue, I would pick the most recent winner and this kind of up and coming global monster. So it'll be interesting to watch what C Limited does over the coming quarters and how its stock fares, given its run so far.
Max, I know this isn't particularly your universe, but is there one that jumps out to you here?
No, I'm going to be honest. I don't know much about, I don't know if you made these companies up. This must be how you guys feel when I talk about
every
biotech.
stock you mentioned, Max. That's pretty much how I feel.
I'm going to bring up.
I think they make pool noodles, right?
It is something like that. I'm going to bring up a conversation that happened on Twitter where someone was making the case for C Limited, and I made the case that why it's not my strongest conviction. And I don't want to say the person got a little bit angry, but they were pretty heated. And my response was, we don't all have to all buy the same stocks. Like, you might think Amazon is eventually going to crater, and I might think it's an amazing stock to own. Nothing harms me of you not buying shares. Like, the reason we have these discussions, or even on our team, if you asked all five of us, because I'll leave Max and Manisha out, about C Limited, half of us would agree, half of us would have different opinions. Some of us would want to own it for different reasons. There doesn't have to be groupthink when it comes to the market. That is the fun part of doing this. Max, Steve, that finishes up today's episode of 7 Investing Now. If you have questions for us, send us an email to info@7investing.com. It is usually Steve who feeds those emails, but he'll pass them out to whichever one of us you want to talk to. Mm-hmm. And of course, you can hit us up at 7investing on Twitter. We're all on Twitter quite a bit, even Max. For Max, for Steve, I'm Dan Kline. Remember to join us Friday when all 7 of us, first time ever, are going to be taking your questions. And also, get on social media, get on @7investing and share that. And of course, Wednesday show, Max and Manisha talking about the ASH conference. You might not understand it, but there's going to be lots of great investing advice. With that, we'll see you Wednesday.